Chapter 13, we're going to talk about liability, asset, and inadequate disclosures fraud. And this is, again, a catch-all fraud. We've talked about revenue and inventory fraud. And this is going to capture the other types of financial statement fraud. Now, when we talked about revenue fraud and inventory fraud, we also talked about some asset frauds, because if you commit revenue fraud, you're also going to commit asset fraud because your accounts receivable are going to be overstated. So there's going to be a little bit of overlap between Chapter 13 and Chapters 11 and 12, but there's also going to be some differences. So the learning objectives are to identify fraudulent schemes that relate to understating liabilities. We're going to talk about overstating assets, and then we'll talk about inadequate disclosures fraud. So the types of financial statement fraud that we'll be discussing can be encapsulated in waste management. So waste management was actually an Andersen client in the Houston office, just like Enron. And waste management occurred several years before Enron. But it's because of the waste management fraud, because it had just been settled right before Enron hit, the Department of Justice really had no love for Andersen at that point. And the Department of Justice didn't really want to see the big five auditors go down to big four. They didn't want to see the demise of Andersen. But they were so frustrated with Enron and then WorldCom that came right on the heels of waste management that they decided to throw the book at Andersen and actually charge him with obstruction of justice. So charge Andersen criminally, and that ultimately did him in. I mean, they may have had trouble staying afloat anyway, just because their reputation was shot, but the fact that they're under a criminal investigation sort of sealed their fate. But in the waste management fraud, Waste Management's a company that has, as their name sounds, they're a disposal company. So when you see the trucks driving by on the street that say Waste Management, that's not actually the company that committed fraud. That's the company that acquired the company that committed fraud. And as you can expect, waste management companies, they're one of their biggest pieces of equipment are disposal trucks. So they have those waste management trucks that drive all over. And if you want to overstate your net income, one way to do that is obviously to understate your expenses. And if you have a large amount of property, plant, and equipment that's related to waste management trucks or disposal trucks, one way to decrease your expenses and increase your net income is to change your depreciation methods. And so basically what they did is they just said, well, we've got these trucks, and we're going to extend the useful lives of these trucks from 7 years to, let's say 15 years. We're going to increase the residual value on these trucks. And by doing so, they drastically decreased the amount of depreciation expense they were taking every year, which materially overstated their net income. So it had two effects of understating their expenses, but also overstated, consequently, their fixed assets. So as we talked about before, if you want to commit financial statement fraud and your goal is to overstate your net income, then you have to do something either to revenue or expenses, so increase revenue by crediting revenue, or decreasing expenses by taking expenses off the books. So like what WorldCom did is credit the expenses, then debit fixed assets. So whether you're overstating your revenue and putting the debit as an asset to accounts receivable, or you're understating your depreciation expense and overstating your fixed assets because you're not taking enough depreciation, the net result is that you have too many debits on the balance sheet, too many assets, which leads to either fewer debits or more credits on the income statement, which leads to higher income. So you can't put the fake debit and the fake credit on the income statement. The debit has to be on the balance sheet. So that's what the Waste Management did. They said they didn't commit revenue fraud. But the biggest portion of their fraud was understating their depreciation expense, which consequently overstated their fixed assets. But there's a lot of other ways to overstate your assets and also understate your liabilities. So we're going to talk about those here as we go along. There's been plenty of schemes to understate liabilities. And one thing that you can do is understate your accounts payable or understate your accrued liabilities. So you just don't record liabilities that you legitimately have. So if you, for example, your utility bill, you usually don't get your utility bill from the electric company, until the following month. So if you just fail to record accrued utilities for the month and just wait until you pay the invoice, then not only did you understate your liabilities, your accrued utility expense, you also understated your expense for that month. Right? So you can just simply fail to record accounts payable or accrued liabilities. And we're going to talk about each one of these in turn, but recognizing unearned revenue as earned revenue. So we know that unearned revenue is a liability because it's cash that's been paid to you, but which you haven't earned. So if you don't perform, then you owe the cash back to the customer. So it's an unearned revenue. But one way to commit fraud is to record that as earned revenue and not as a liability. We'll talk about all these things as we go. Also under-recording future obligations like warranty expense. And then not recording or under-recording various types of debt. And we'll talk about not recording mortgages or notes, and then failing to record contingent liabilities. So we talked about accounts payable can be understated by a combination of not recording purchases or recording the purchases after year end. You can overstate purchase returns or purchase discounts. So overstating how much you actually returned of the inventory that you purchased, or overstating the discounts that you were able to take, which will understate your accounts payable. And make it appear that you've paid off your liabilities or they've been forgiven when they actually have not. So related to that are failing to record accrued liabilities, because there's a lot of liabilities that we don't wait until we get an invoice for. We have to accrue for them. So at the end of a quarter, at the end of a month, we sit down and think, what are the expenses that we've incurred, but yet we haven't recorded the liability yet. For inventory, for purchases, when items have been received and then an invoice comes in the mail, there's sort of a logical time to record that liability. But for a lot of things like salaries, for example, the employees are not going to send us invoices. So at the end of the month or at the end of the quarter, we have to sit down and figure out how much of the wages we've paid to our employees and how much we still owe them. And let's say the end of the month comes during the middle of a 2-week pay period. And so we're 1 week into a 2-week pay period. We'd have to accrue the salaries and wages for that 1 week and put it on our balance sheet at the end of the month as wages payable, and then record the salary expense on the income statement. If we fail to do that, then we understate our salary expense and we understate our liabilities. Right? Same thing with payroll taxes. Just like if we have to accrue for the salaries that's owed, we also have to accrue for the payroll tax that's owed. If we fail to record that, we've understated our payroll tax expense and understated the liability. Right? Rent, utilities, interest, these are all things where either the invoice is going to come after the end of the month, or like in the case of interest, we may not even receive an invoice, but we know that we have debt, and until we've actually paid the interest, once the interest has been accrued, we need to accrue the interest expense. And if we just haven't paid the cash, we put it in interest payable. So anytime we fail to accrue for an expense that we've already incurred, and we fail to put the liability on the balance sheet and the expense on the income statement, then we understate our expense for the current period and understate our liabilities. Now it has the effect of doing the opposite in the next period, because the next period when we pay it, we're going to record the expense then. In that case, it's going to overstate our expenses in the next period, so that's going to reverse. But a lot of times people think, well, I'll deal with that later on. I just need to understate my expenses for this period so I can meet earnings targets that I've set for myself, and I'll deal with the double counting the expenses in the next period. The other issue comes with recognizing unearned revenue as earned revenue. So if, for example, we're an insurance company and people have paid us their insurance premiums, they've prepaid it, which is what they normally do, then we can't record that as revenue as the insurance company until we've actually insured them for the insurance period. Right? Same thing if we want to fly with Delta, we buy a ticket from Delta, that's unearned revenue for Delta until we've actually flown. Right? So whenever we pay for a flight, because we always pay ahead of time, that's unearned revenue for the airline. Now, the airline can't record that as revenue until we've actually flown. Right? So, but one thing that people can do to manipulate or overstate their net income is to take that money that's been received and just record it as revenue earned, even though it's unearned revenue, right? And the unearned revenue is a liability versus revenue, because, like, for example, if Delta Airlines fails to fly us to our location, then they're going to have to refund our money. Same thing if we prepay our rent for our office space, and then the company sells the building and doesn't let us stay there, then they're going to have to refund us our prepaid rent, right? In which for them it's unearned revenue, and if they fail to provide the leased space for the agreed upon amount of time, then they have to return it. So it's a liability to them until they've actually let us stay in the location and the lease period's up. So that's one way, sort of obvious way, to overstate your revenue and consequently understate your retained earnings by recording revenue before it's actually earned. So under recording future obligations, so if we sell product and that product has a warranty, we have to estimate what that warranty expense is going to be and set up a liability, reserve for that warranty expense. If we fail to do that, then we've under-recorded our expenses, and we need to record the costs of the warranty in the year that we make the sale to appropriately match the expense with the revenue. So when we make the sale of so many products for a year, we have to estimate how much of that product is going to come back, or we're going to have to spend a certain amount of money fixing that returns related to those products because they're under warranty. So we need to estimate the warranty expense for those product sales in that period. So we set up a warranty reserve and debit warranty expense at one time. If we fail to do that, right, then we've obviously understated our warranty expense, and we've understated the liability related to that. And so it could be a warranty, it could be other service obligation by which we've obligated ourselves. And so we need to set up a reserve for future expenses and then record the expense now, or future obligations and record the expense now. It's the same thing that happens with bad debt expense. If we don't record enough bad debt expense and put it in the allowance for doubtful accounts, then we've overstated our accounts receivable and understated our bad debt expense. So anytime we fail to record a future obligation, then we understate a liability and we understate an expense. So if we don't record other types of debt, like a note or a mortgage, and there's a lot of ways this could happen. We can borrow money without recording the corresponding liability. So we can, instead of recording it as a liability, like in the case of unearned revenue, we record it as, like with unearned revenue, we record it as revenue, and then we record the cash. Right? But in reality, that may be cash that wasn't a sale, and it needs to be paid back, and it was actually debt. Right? So failing to record debt, or claiming that the debt that we have on our books has already been forgiven by our creditors, is also one way to overstate our current liabilities. And there's a lot of ways to look for these understated liabilities. For example, if we fail to record accounts payable, one thing that we can do is look at the subsequent cash payments after year end to see what they're paying. Because if we're paying utility bills and legal expense and paying salaries and wages, and we see those checks going out in the next month or in the next year, and we go back and we look at the corresponding documentation to see when those expenses were incurred. Well, if they're incurred in the prior year, then those are obviously unrecorded liabilities and unrecorded expense. So looking at subsequent cash disbursements, so looking at items that were paid after year end, will help us determine if they should have recorded a liability for an expense, and if that expense was because that expense occurred in the previous year. Same thing with warranty expenses. I mean, if we start paying warranties, paying to have things fixed because of warranties, and we look at the product that was returned and it was from a sale in the previous year, and they haven't recorded a warranty reserve and taking the cost of fixing the item to the reserve, and they're taking to an expense, then in the next period, then we'd be concerned. So looking at items that they're paying after year end is crucial. It's also the one way to also detect unrecorded liabilities is to look for what they accrued for in prior quarters to see if they should be accruing for the same thing in the current quarter. So if they had wages payable in the prior year or the prior quarter, and they had income tax payable in the prior quarter, and they had real estate taxes payable in the prior quarter, but they don't have those payables this year, then we can logically assume that they're understating their expenses in the current year by failing to record the normal accrued expenses that they incur every quarter, every year. Right? We also can look for things just like to do a bit of a sanity check. Like if they have property tax expense, and you know that they bought some new buildings and bought a new warehouse this year, you would expect their property tax expense to go up, right? And correspondingly, you see property tax payable would go up. If we know that they've purchased more property and they haven't recorded any additional property tax expense, then we're going to be suspicious. So it would be the sort of the same thing with net income. If our net income is higher, but their income tax payable or their accrued income tax is not getting any higher, then we would be suspicious. And so the other thing too is if they have interest expense that appears to be too high. So maybe we know their cost of capital. In general, they pay interest expense at about 8%. That's what it costs to borrow money. But for the amount of debt they have related to the interest that they're paying, say the interest that they're paying represents 20% interest on the debt that they're reporting, then you might be suspicious that they're understating their liabilities because they're paying too much interest in that case. So those are ways to look for under-recorded debt and under-recorded liabilities. So the omission or contingent liabilities is another issue. So if a company, for example, is being sued by one of their competitors for infringing upon one of their patents, the competitor's patents, and it's probable that they're going to lose that case and the lawyers can estimate what the damages are, then they have to record that contingent liability on their balance sheet right away. So if there's, and contingent liabilities oftentimes arise because of liabilities, the likely loss related to a liability. So one way to look for that is to do confirmations with their lawyers, for example, and ask the lawyers, hey, are you representing this company in any cases? And if the company is being sued, then you ask the lawyers and say, okay, I understand you're representing the company in these cases. What's the likelihood they're going to lose? And if the lawyers say it's probable, and they can estimate what the potential damages are, they don't wait until the lawsuit is settled. They record the contingent liability right away. And that's the opposite for gains. So if they're suing somebody, if they are suing somebody and they potentially could win a lawsuit, we don't ask the lawyers if it's probability they're going to win and then record a contingent gain. That doesn't happen. Because of the conservative nature of accounting, we don't record gains until they actually happen, but we record the liabilities as soon as they become probable, right? And so in a contingent liability related to a loss, if that loss becomes probable at any point, then we need to record the loss right away, even if it hasn't happened yet, right? So one thing that we can do is talk to the lawyers. We can also talk to banks and talk to other folks that they do business with to determine, is there a possibility that they're going to lose a lawsuit? Maybe they think it's probable they're going to be fined by the EPA, so we talk to the Environmental Protection Agency to find out, if they're bringing cases against the company that it's probable they're going to be fined. As soon as they think it's probable that they're going to be fined, they need to record that loss immediately and record a contingent liability. So looking for understated liabilities is one of the hardest things we do as auditors because we're looking for things that aren't there. In the case of asset fraud, the assets are overstated. So like in the waste management example, those garbage trucks are there. We're just trying to determine if the value of those trucks is overstated. So we know what we're looking for and then we can test for it. But in the case of omitted liabilities, we're searching for items that we don't know if they're there or not. That's a little bit harder. And so that requires a lot of time and effort talking to people they do business with, talking to banks, talking to lawyers, and trying to figure out if there's potential contingent losses or unrecorded liabilities that the company needs to put on their books. And it's a pretty common problem in companies. And another way to do this, to overstate your assets, are to understate your liabilities is to fail to record a capital lease. So if, let's say the company purchased an office building, but they decided, you know what, I don't want to put this office building in my name because then I'm going to have additional property, plant, and equipment, but I'm also going to have the corresponding mortgage because maybe I got a 30-year mortgage on this office building. So what I do is I tell the bank, you know, I'm going to put the office building in your name, and instead of getting a mortgage, I'm just going to agree to lease that building from you for 30 years, right? Instead of paying the mortgage for 30 years. And then the lease payment is going to be shockingly close to what the mortgage payment would be. And in fact, you tell the bank, I'll be in charge of maintaining the building, you know, caring for the building. If anything happens to the building, I'll be responsible for it. And so the bank says, yeah, that's fine. I'll leave the building in my name. And instead of paying a mortgage, you know, what you would call a mortgage, you can just make us a lease payment. And then at the end of the 30 years, you'll automatically get the building. It'll become yours and we'll put it in your name. Well, in that case, you're not actually leasing a building, you're buying it, right? Because the risk of loss is with you. You're going to use the building during its entire useful life, which is the 30 years. You're going to get the building at the end of that 30 years. And the present value of the lease payments is the same as the fair market value of the building. Right? So in that case, even though the banks technically agreed to lease it to you, you've actually bought the building. And so that's a capital lease, and you need to record the building as property, plant, and equipment on your books, and the present value of the lease payment, which essentially is the fair market value of the building, you need to record as a liability on your books. But some companies, because they can't take on more debt, because maybe they have a bank, they already have a bank loan, and the bank says they can't take on additional debt, they'll try and structure purchases of property, plant, and equipment. They'll try and structure as an operating lease versus a capital lease so that they can keep the property, plant, and equipment off their books, but more importantly, keep the liability off their books. So that's another way to understate their liabilities, is to report something as a capital lease when it should appropriately be, report something as an operating lease when it should appropriately be a capital lease. And that's oftentimes one way that people use what's called off-balance sheet financing. So they get somebody to lease property, plant, and equipment to them. They call it a lease, even though they essentially wanted to buy it. And the rules related to capital leases, if you remember, are if the lease is more than 75% of the useful life of the building or the property that you're leasing, or if the present value of the lease payments is 90% of the fair market value of the item that you're leasing, or if the item that you're leasing reverts to you at the end of the lease period, or if there's a bargain purchase option. And those are all indicators that you have a capital lease, and you need to record that item that you're leasing as a property on your books, and record the liability for the fair market value of the lease payments on your books as well. Okay, so that's another way to search for unrecorded liabilities, is to look at the property, plant, and equipment and determine what's been leased, and then look at those lease agreements to determine if they should be recorded as capital leases. So we've talked about ways to detect understatement of liability. We've talked about the analytical symptoms, where we're looking at interest expense. Maybe it's too high, like we talked about. Looking for what their accounts payable and accrued expenses were in the prior year. And because if operations are about the same, then you would expect a similar amount of accounts payable and accrued expenses in the next year. And so consequently, that'd be looking for accounts payable balances that appear to be too low, right? Purchase of goods sold numbers are too low, so the purchases and cost of goods sold are too low. Returns and discounts are too high. Unearned revenue, right? That's where payables or other accrued liabilities appears to be too low, or income's too smooth. Because companies are generally trying to manage their earnings to meet analyst expectations, like we talked about. And analyst expectations are usually consistent across time. So for example, if they had a 5% increase in income for the past 5 years, and then the 6th year, they're going to expect a 5% increase in net income. And then the 7th year, they'll expect a 5% increase in net income. And you'll see a nice smooth trend line, which is what investors like to see because that's very predictable. But in reality, companies grow in fits and starts. And so they may have grown 2% one year, and then 8% the next year, and then 4% the following year, then 10% the next year, and then they didn't grow at all the subsequent year. But if you aggregate that out or average it out, it's about a 5% growth rate, but it's up and down over time. So when income appears to be too smooth, that trend line's like 5% a year, it doesn't deviate from that, then they're doing something to manipulate their expenses and their revenue to get that nice, smooth trend line. So if you see that, that's indicating that they're managing earnings and they're doing something related on their balance sheet related to either understating liabilities or overstating assets. So we've talked about recognition of unearned revenue. So unearned liabilities appear to be too low and revenue accounts appear to be too high. So in the past, they've had a significant amount of unearned revenue. This year, they have very little unearned revenue and they have record revenue, earned revenue. Then you might be suspicious that they inappropriately recorded earned revenue that was actually unearned revenue. So under recording or non-recording service warranties. So if your warranty expense continues to go down right across time, that might make you a little nervous, especially as compared to sales. So sales are going up, but your warranty expense is going down. Then you're probably understating your warranty expense and consequently understating your warranty reserve. So unrecorded contingent liabilities, and these are the hardest thing to detect because you don't know about contingent liabilities. So that's where you have to send confirmations to banks, to lawyers, to regulators, and trying to figure out if there's potential fines or losses coming down the line that need to be accrued because they're probable. So unrecorded notes and mortgages, right? Again, unreasonable relationship between interest expense and recorded liabilities. That's where interest expense appears to be way too high compared to the amount of liabilities that you have. That might indicate that there's actually you're paying interest on liabilities that are not on the books. Right? Significant purchases of assets with no recorded debt. Right? So they bought this new office building and there's no corresponding debt. You're like, how is that possible? And they say, oh, well, we're leasing it. Okay, how are you leasing that building? Right? Maybe you failed to record the purchase and not subsequently failed to record the debt. Right? So significant decreases in recorded debt. So their recorded debt's going down, but you don't have any evidence of them actually paying it off. So you press them, they ask questions, and they say, oh, this is debt forgiveness, or they give you implausible answers for why the recorded debt's going down. And then recorded amounts of note payable, mortgages payable, lease obligations, pension liabilities, those appear to be too low. And then when you say too low, it's too low compared to what? It's too low compared to your expectation. Right? So if you know in prior year what their notes payable were, and then they don't have those notes payable this year, you're going to be suspicious, right? There's no evidence that they paid them off. Right? When they have pension liabilities, and their pension liabilities gone down, even though they're hiring more employees and more employees are vesting, then you're going to be suspicious. So you might look at their pension liability relative to the total number of employees, right, and see if that's growing in a consistent relationship. So these are all analytical symptoms that could point you to underrecording liabilities. And like we said, if you underrecord the liability, the purpose is to correspondingly understate the corresponding expense or loss. Well, we've talked a lot about accounting or documentary symptoms, really photocopied records. Whenever you see photocopies when the original should exist, you're going to be suspicious. Right? So if they have a loan agreement and you want to get a copy of it, and they can't produce the original loan agreement, they just give you photocopies, then obviously the concern is that the photocopy's been doctored, because that's what companies that commit fraud do. They doctor the originals to provide an audit trail, and so they say, oh, we don't have the original, we have a photocopy. Well, yeah, you should always be suspicious when they don't provide you with original documents. Unusual discrepancies between the entity's records and confirmation replies. So you sent confirmations to banks, and banks say, no, they actually owe us more money than what they've stated out in this confirmation. So that's one way to search for unrecorded liabilities, is to send confirmations to their bank and say, here are the liabilities that they say they have with you. Are there any more liabilities besides these? And are these bigger than what they're stating? Right? So sending those confirmations and getting discrepancies back. Transactions not recorded in complete or timely manner or inappropriately recorded amounts. So they're failing to record for example, these accounts payable so they're getting invoices, they're just putting them off to the side, they're not recording the corresponding expense. And then you're going to find that in the next year when they're actually paying those invoices, right, in the subsequent month. And you look at the supporting documentation, you find out it's for items that were received in the prior year. Right? Again, balances and transactions that lack supporting documentation or missing documents, those are always going to be suspicious whenever they're missing documentation. So they have information, they're being sued, you've read about it in the news, but they don't have any documentation related to the lawsuit. They don't want you to contact their lawyers. Right? That's going to be a concern that they're failing to record a contingent liability. They have unexplained items on reconciliations. So the bank reconciliation or their accounts payable ledger doesn't reconcile to the general ledger. Right? Maybe they failed to under-record some accounts payable. So all these things, these are common accounting and documentary symptoms that are related to understatement of liabilities, but these same type of items, missing documents, photocopy documents, unusual discrepancies, you're going to see these in all types of financial statement fraud, whether it's revenue fraud, inventory fraud, liability fraud, overstatement of assets. Right? So in the overstatement of assets fraud, right, there's a lot of ways that you can do. You can overstate cash or short-term investments in marketable securities. That's a little bit harder to do, especially with cash, but it's been done in the past, so we'll talk about it. Overstatement of inventory, of receivables and inventory, we've talked about that, but there's other ways to do that besides understating cost of goods sold and overstating revenue. We'll talk about some of those. The overstatement of fixed assets, we're going to spend some time talking about when you're, like with waste management, your assets are, your garbage trucks are overvalued because you haven't been taking enough depreciation. And then overstatement of assets through mergers and acquisitions, we'll talk about that. And then overstatement of intangible and deferred assets, like goodwill. So overstatement of a fixed asset, like what can you do? Well, if you're waste management, you can extend the useful life of your garbage trucks and then record less depreciation, and consequently your cumulative depreciation is too low. And so the value of your assets are too high. But also when the garbage truck becomes worthless and you're ready to just take it to the dump and then buy a new one, but it's overvalued because you haven't taken enough depreciation, so it's still got significant value, and you just fail to report that you disposed of that asset. And so leaving worthless and assets that are otherwise disposed on the books. Right? Underreporting depreciation expense, like what we talked about, that leads to overstating the value of the corresponding asset. Or you record fixed assets at inflated values. So when you buy a new building, for example, you put some improvements into the building, you overstate the cost of the improvements, and you put other things in there like the cost of money to insure the building and a bunch of other things. You capitalize it into the cost of the building. That's inflated the value of the building, right, and understated your expenses during the current period. So colluding with outside parties to overstate assets, that happens on occasion, and it's usually with related parties. So we'll spend some time talking about some related party transactions where people were able to overstate their assets through related party transactions. And oftentimes they're able to overstate their revenue related to related party transactions as well. And then fabricating fixed assets to record on the financial statements. So it may be that you create assets that should be expensed, like in the case of WorldCom, they had expensed a lot of just normal business expenses, but then their expenses were too high to meet their earnings targets. So they just called some of the expenses, they just made up a name and called them fixed assets. So they just fabricated fixed assets out of what should be an expense. So what they did is they credit the expense to take it out of the expense account and debit the fixed asset like we talked about. So that takes assets off the income statement, takes expenses off the income statement and then calls them fake assets and puts it on the balance sheet. So overstatement of cash, short-term investments in marketable securities. This doesn't usually happen because cash is the easiest thing to audit. You just send a confirmation to the bank and the bank confirms the cash, the amount that's on hand. But there have been some famous frauds like Parmalat in your book and Satyam, were international companies that overstated their cash balance. And one way they did it is they just when the auditors set confirmations to the bank, they set fake confirmations back to confirm that cash balance that didn't actually exist. So they actually were able to fool their auditors into thinking they got confirmations from the bank about their cash balances, but in fact the confirmations came directly from the company. Now you can overstate short-term investments in marketable securities. It's a little bit harder, but a lot of times we think of marketable securities as securities that are sold on like the New York Stock Exchange or the NASDAQ. And it's hard to overstate the value of those securities because there's obviously, if you look at the NASDAQ or the NYSE, you can see what it's trading at any given day. So it's hard for the company to say it's worth more than what the underlying stock's trading at. But not all stocks are traded on exchanges. Some are traded over the counter. And so some stock is harder to value, right, because there's not a market value that's quoted every day. So in that case, you can't overstate the value of your investments, and people have done it. They said, hey, these short-term investments that we have in these small companies that are not traded, that are traded over the counter, we say the value is worth this, and maybe there's not supporting documentation for that, but the auditor trusts the company's valuation of it, and they're allowed to overstate their short-term investments. But in general, this is people that commit financial statement fraud don't usually attempt to do it in cash, short-term or marketable securities, because they tend to be easier to audit. Now, like we talked about, they do overstate their receivables and their ending inventory. One way that the receivables get overstated is if they create fake revenue. Obviously, they create the fake debit to revenue, and then the fake credit to revenue, and then the fake debit to receivables. But and then with inventory, like we talked about, they overstate their ending inventory, which understates their cost of goods sold. So they have too many debits in inventory on the balance sheet and not enough debits on the income statement. That should give a cost of goods sold. But sometimes companies people can steal cash, so they can steal customer checks. Maybe employees of the company are stealing customer checks on a material basis, and then leaving the asset, the corresponding legitimate receivable on the books, but it's no longer a collectible receivable because the asset's been paid, so that the receivable should have gone away. But you steal the customer check and leave the receivable on the books. Is another way to overstate your receivables. So it's not always through overstating revenue. You could steal the corresponding cash when it comes in and then leave the revenue on the books. And that's what management does when they loot the company. They'll take customer checks and take assets off the books and still leave them on the book as if they're still there as an overstated, whether it's overstated cash, overstated fixed assets, or overstated accounts receivable. The corresponding asset's been taken, but it's been left on the books. So overstatement of an intangible or deferred asset, that's where, like goodwill. So you acquired another company, and for example, an easy example to understand this concept is when Facebook acquired WhatsApp. They acquired them for like $20 billion. Well, the fair value of the assets that they acquired from WhatsApp, the office building where WhatsApp was, the tables and desks and chairs and computers, was not worth $20 billion. Obviously, they were buying an intangible asset, which was their customer list. And they had millions and millions of customers around the world using the WhatsApp application. And so Facebook valued that at $20 billion. Well, when they record that purchase on their books, the assets that they acquire that are on WhatsApp's balance sheet are not worth as much as they paid. So the difference between the fair value of the assets of the company that they acquired and what they actually paid is called goodwill, right? And you would expect that if you were to purchase McDonald's corporations, for example, you'd have to pay more than the value of all the restaurants and the ovens and the fryers and everything, because that McDonald's name has a brand. And so if you wanted to buy that brand, you'd have to pay more than the fair value of the assets that you would actually get. So when you do that, you record goodwill on your books for the difference. But if, for example, you buy WhatsApp and then everybody stops using WhatsApp and they use some new technology, so maybe somebody starts a technology called WhatsApp and everybody switches to that, and nobody's using WhatsApp anymore, then you have to say, okay, that goodwill, the amount that we paid above the fair market value of the assets is no longer as valuable as we thought. So we need to we need to amortize it or write it off. Right? And if you fail to write it off, then you fail to take that loss from the amortization of the goodwill, that loss that would go to the income statement, and then your goodwill is subsequently overvalued on your balance sheet. And related to that, sometimes startup companies, they can capitalize startup costs. So the cost to hire the lawyers and get the company up and running. If it's truly a startup cost for starting up a building, then you can capitalize those costs and then expense them by writing them off over time, by taking a deferred charge for the startup costs over time. Well, one way to overvalue the startup costs is to put everything, just throw the whole kitchen sink into the startup costs and then defer it over time. So you could be recording not just startup costs, but actual expenses. So it could be advertising expense, could be salary and wages payable to your employees, could be cost of goods sold, could be anything. You just dump all those legitimate expenses, call them startup costs, and then you understate the expense by not recording them now. Now, of course, you're eventually going to have to write it off, so it's eventually going to go to an expense. So in the future, your expenses are going to be lower, but in the short run, your income is going to be lower because you're going to have to write it off eventually. But in the short run, you capitalize it as startup costs and avoid the expense of recording it now. So there's a lot of different ways to overstate intangible or deferred assets. One way is to use market value rather than book value when you acquire. Well, you may think, okay, I'm going to record an asset and I'm going to record it at its market value. I'm going to write it up. So I've got something on my books that, maybe a piece of land, and I'm supposed to leave it at historical cost, but I want to record its current market value. And so somehow I'll find a way to convince the auditors and others that maybe I sold the land to somebody else and then bought it back at its market price, so then I can reestablish the cost up to market. So whenever they're adjusting items that should be at historical cost up to market value and taking that gain, then that's potentially financial statement fraud. If they do an acquisition, and this is a little bit tricky, but have the wrong entity be a purchaser. So, like, for example, you could set up a shell company, because when you acquire a company, so like when Facebook bought WhatsApp, when they got WhatsApp's assets, when they figured out what the goodwill was, they took WhatsApp's asset, and WhatsApp had it on their balance sheet, all of their assets, their computers and everything else at purchase price, less any accumulated depreciation. Well, let's say WhatsApp had an office building that's now worth more money than what they paid for it originally, because the land value in Silicon Valley has gone up. And so when Facebook acquires them, they estimate what the market value is of all the assets that they purchased, and then they bring those assets on the books at their market value versus their book value. Then the difference between the market value of those assets that they actually acquired and the purchase price that they paid is the goodwill, right? So when you acquire a company, you bring all of their assets onto your books at their market value versus their book value. So like for example, I don't think they did this, but if Facebook had acquired WhatsApp and WhatsApp had a building, an office building, and that office building was worth more money than what they originally paid for it, that office building is on WhatsApp's book at cost, but then Facebook buys the company, so they get the buildings too. So Facebook records the building at its market value, not at its current market value. So they'll get an appraisal on it and then record it at its current market value, then depreciate it from there. So one way to if you really want to be tricky and overstate your assets, what you can do is sort of fake being acquired by somebody. That way it allows you to write your assets up to their market value. So you create a shell company that supposedly acquires you, and then you put your assets on the shell company's books at market value because they got acquired, right? Because you just got acquired by this other company. When in reality, the other company was just a shell company, and it never really was an acquisition. And so you never should have been able to write your assets up to market value to put them on some purchaser's books. So companies have done that in the past. There's some examples in your book of that happening, right? Or you can allocate costs among assets in inappropriate ways, right? So if you acquired a building and some leasehold improvements, you might say, well, some of the cost of this acquisition relates to the building and not the leasehold improvements, because if it's related to the building, then we can appreciate over 30 years, where the leasehold improvements might have a 7-year useful life, right? So misallocating the cost to actually the purchase price of the building versus the improvements, the building improvements, could cause you to overstate your assets over time as you use a useful life, a building useful life versus an improvement useful life. Then recording fictitious assets or inflate the value of assets in intercompany accounts and transactions. So, obviously, if you're buying, intercompany transfers, so one part of the company, one segment of the company or division of the company is selling assets to another division of the company. Maybe they record the sale as a legitimate sale, like it was a non-related party sale, and write up the value of the asset to that sale price. Like that would be suspicious, and it would overstate your assets. So ways to detect for overstatement of assets, right? Obviously, if you see changes and trends in the accounts and the financial statement account, that just don't make sense, right? So if your accounts receivable just keep going up, right, but revenue's going down, you have a right to be suspicious. Right? Changes and trends in the financial statement relationships, and that's what you're looking for is changes and unusual trends, right? And so, if, like we talked about, if you have, well, it could be accounts payable or accrued expenses, and you don't have any of those in the current year, then they're going to be missing. So that would be detecting unrecorded liabilities. And detecting these overstated assets would be similar. You would look for assets on your books, and if they're constantly purchasing new equipment on a regular basis, and then they stop purchasing new equipment, then you'd be suspicious. Why were you and generally you spend about $5 million a year purchasing new property, plant, and equipment to keep your equipment new as it wears out, but then you stop doing that, right? And that would be suspicious. That maybe they are purchasing property, plant, and equipment, and either failing to record it, and because they don't want to record the liability, or maybe they're purchasing more property, plant, and equipment than they have in the past, and that might lead you to be suspicious as well. So whenever you see unusual relationships and trends, then you have some questions to ask about what's causing this difference and this change in your business, when we know that your business has been pretty consistent across time. We're not aware of your business growing in any significant way, but yet we see fixed assets that appear to be growing or not being written off in a fast enough manner, like through depreciation. And then compare financial statement balances with non-financial information and other information. So we're going to spend the next chapter talking about that, how to use non-financial information to assess whether your financial statements are overstated. So we'll do that in the next chapter during week 4. Then compare financial statement balances with policies that are used by similar companies. Right? So if Waste Management has 20-year useful life on their garbage trucks, but then you look at another waste management company, a competitor, and their useful lives are 7 years, then you're going to be suspicious, right? And the residual values of Waste Management are really high compared to residual values of competitors, then you would right to be suspicious that they're understating their depreciation expense and consequently overstating their property, plant, and equipment. So then the last thing here, we're talking about inadequate disclosure fraud, and that's where the company just doesn't disclose information that they should, right? And it may correspond with financial statement fraud itself on the financial statement. So if you fail to disclose that you had a lawsuit, because that's one of the footnote disclosures is whether you're being sued and what's the status of those lawsuits. Right? If you fail to disclose that, and you may also subsequently fail to disclose the contingent liability related to that. You can make misrepresentations or omissions in the MD&A, and the MD&A is the management discussion and analysis. And that's what, during the first half of the financial statements, management's just talking about the company and talks about its risk, gives you information about the company, gives you some summarized financial data, quarterly data. I have 10 years of summarized other financial data, annual data. And so when you look at the financial statements themselves, like if you read a 10K, the financial statements on a 10K don't start until item 8. So the first, and it's about halfway through the financial statements, but the first half of the financial statements is management discussing things. And if they're discussing things and they're making misrepresentations, and your job as an auditor is to read that MD&A, you don't have to audit it. Like if they say, if UPS says they have 530 planes, you don't have to audit that number to actually see if they have 530 planes. But if during the course of your testing of property, plant, and equipment, you realize that they only have about 300 planes because that's all they're depreciating, but then they said in their MD&A that they had 500. So even though it's not your responsibility to audit the number of planes that they have, it's inconsistent with the information that you gleaned by doing your audit. Then you'd want to point that out to them and say, hey, you're misrepresenting the facts here. I happen to know from property, plant, and equipment, you only had about 300 planes because that's all we were depreciating. You said there's 500 planes in the MD&A. That's too high, right? That'd be a misrepresentation. But they also might misrepresent or omit items in the footnotes, which is what you are responsible for as an external auditor, that they actually get the footnotes right as well, not just that they followed GAAP, but part of GAAP is getting all of the proper disclosures in their footnotes, right? So if you're reading their footnote disclosures, and it's after year end, and you know that a hurricane's come and wiped out one of their buildings, and they didn't have any insurance on it, they need to disclose that as a subsequent event. So December 31st is their year end. At end of January, a hurricane came, destroyed their warehouse. They didn't have any insurance on it. Then they don't have to change the balance sheet to show that as of December 31st that the property, plant, and equipment was gone, the warehouse was gone, because it didn't happen until the new year. But they do need to have a footnote in the financial statements that says, subsequent to year end, this hurricane came and destroyed one of our warehouses, and subsequently we suffered a loss of X amount of dollars related to that. And the property, plant, and equipment is different. Now, so you haven't released the financial statements, so that subsequent event needs to be in the footnotes. If they fail to record that footnote, then they've misrepresented the company, right? And so you need to know what the footnote disclosures requirements are to make sure that they've complied with all of those disclosures. One of those items in the footnotes that they have to disclose are related party transactions. So in the case of Enron, Andy Fastow, who was the CFO, he was trying to make Enron's financial statements look better than they really were, right? Obviously, net income would be higher than it really was. And they had a bunch of investments that were losing money. So he created a special purpose entity. So he got some of his buddies to invest money into this entity that he created and controlled. And then he sold some of those investments to this other entity that he also controlled with the purpose of buying back those investments after year end at overinflated prices. So he was able to get these bad investments off the books for a short period of time, and it looked like they didn't suffer a loss on these investments, just to buy them back later, right? And those special purpose entities were also controlled by Fastow. So Enron knew that they had to disclose in the footnotes when they have a related party transaction. So in the Enron footnote and for year 2000, you can see a related party footnote, and it says our CFO has an entity that he also controls, and they did business between the two of them. But it didn't describe the nature of the business or how big the business was. And if they had made proper disclosures and provided more information about that related party transaction and what the transaction entailed, people would have been able to figure out that it was just a means to manage earnings, and there was no legitimate purpose to that related party transaction. Right? So that was a situation where they didn't actually omit the disclosure. There was a related party footnote there, but they didn't disclose enough in that footnote for the average investor to understand the relationship between the related party that SPE, that special purpose entity that FASTA created in FASTA, and how much business had been transacted between the two entities. Had they disclosed that, right, people would have been a lot more suspicious about the nature of those transactions. So that's, as I said, that's part of your job as an auditor, is to know what footnotes are required, to read those footnotes, and to search for anything that's missing. And again, it's difficult because it's like searching for unrecorded liabilities. You're searching for something that you don't know if it's there, right? But that's why it's really important to know the business and the environment that they're operating in. Because if you're auditing similar companies and competitors, you know what types of information should be in that footnote, in those footnotes, and so you can look for that corresponding information to be properly disclosed in your client's financial statements. But you're also aware of what's going on generally with your company. You're reading the news, right? So if you read that the hurricanes wiped out the warehouse, you know that needs to be in the footnotes as a subsequent event, but you don't see it there. You know, you didn't wait for the company to tell you about it. You're proactively searching the press and press release related to companies. And that's what happens for auditors, like external auditors, like partners on the job. Like if you audit General Electric, for example, the partner on the job has like news alerts that whenever General Electric's in the news, the partner, he or she wants to read about it because they want to find out if there's any information in there that's going to potentially affect the financial statements or need to be disclosed in the footnotes that they need to become aware of. So if they read about, things that affect the operations of the company, right, then they also know, okay, if I'm reading that a warehouse wiped out their property, plant, and equipment, I should expect a decrease in their property, plant, and equipment. But if I read that their competitors come out with something better, a product that's better than their product, then I would expect some more depreciation expense or obsolescence expense on their inventory, right? And so by keeping up with what's going on in the news, that'll help you identify what to expect related to analytical procedures, and if you're going to miss any omissions from the footnotes or any misrepresentation in the management discussion and analysis. So they say things that you know appear to be inaccurate because you know the company inside and out. So, like we talked about, ways to look for disclosure fraud. I mean, you want to look for inconsistencies between what you know, what's being disclosed, and the information in the financial statements themselves, right? And so, like if you look at their property, plant, and equipment, and the footnote disclosure, and they tell you how many airlines they have, but then in their MD&A they have more than that, then you're going to be suspicious, right? If you're doing your payroll testing and you know how many employees work for the company, and then they report having more employees, you're going to be suspicious, right? Obviously, you're going to talk to management and question, do you have related party transactions, right? Do you have lawsuits? There's things pending against you. What are your contractual obligations, right? I need to look at your lease agreements because I need to read them in detail to figure out if you indeed have capital lease versus an operating lease. Right? And then whatever information they file with the SEC. So it's not just the 10K, which you're auditing, but also like any 8Ks, which is additional information. It's a special form for additional information. You're going to read those. If they have correspondence from other regulatory agencies, so they're corresponding with the EPA, you want to read that correspondence because maybe they're corresponding so much because the EPA is concerned that they're doing something illegal and they're going to fine them, and you want to become aware of it because there's a potential contingent liability there, right? Or read their correspondence with the IRS. Maybe the IRS is challenging some of their deductions that they've taken, and consequently they're going to audit their tax return, and so that might relate to a contingent liability. So those are things that you want to keep track of. So there's a lot of things out there related to overstatement of assets, understating liabilities, and inadequate disclosure fraud. And some of it relates to Chapter 11 and Chapter 12, like we talked about with revenue and inventory fraud, and some of it is new. So we've covered a lot of ground in this chapter, and that completes the chapters related to financial statement fraud. And next we'll turn to similar, like we talked about, a little more detail about how to use non-financial information to detect financial statement fraud.